Welcome to The Explainer. Today, we're diving into a really critical mindset shift, one that truly separates the amateur traders from the pros. It really all comes down to this. Are you trying to guess where the market is going, or are you letting the market tell you?
So let's just kick this off with a question for you. When you're looking at the market, are you trying to jump in and guess what's going to happen next, hoping to snag that perfect entry? Or do you take a step back and wait for the market to actually show its hand before you make a move? The answer to that question says a lot about your trading.
Okay, here's how we're going to break this down. First, we'll look at what we're calling the prediction trap. It's where so many traders get stuck. Then, we'll get into the psychology of why it's so tempting to guess. After that, we'll see how the market actually punishes those guesses with fakeouts. And finally, we'll open up the professional's playbook and talk about the huge payoff that comes with just a little bit of patience.
All right, first up, let's talk about one of the most common and, frankly, most expensive mistakes you can make in trading. That powerful, almost irresistible urge to predict a pattern before it's even fully formed. You know the feeling, right? That desire to get in right at the very bottom or sell at the absolute peak. We all chase that perfect entry, but as our source material makes crystal clear, jumping the gun on a pattern that isn't complete is pretty much the fastest way to burn through your capital.
And this, right here, really gets to the heart of the matter. It's a total mindset shift. The predictor, the amateur, is obsessed with getting the absolute best price. They think that's the key. But the professional, the confirmer, knows that it's not about the best price. It's about the right price, the one that comes after a move is confirmed. That's where the real probability of success lies.
So, if it's so risky, why do so many of us fall into this prediction trap? Well, the answers aren't on the chart. They're actually in our own heads. The whole thing is rooted in some really common psychological biases.
And you don't have to take my word for it. As one of our sources points out, the real fight isn't with price action, it's with our own brains, especially when we're under pressure and there's real money on the line.
You see, these biases mix together to create this kind of dangerous cocktail. First, you've got overconfidence. You nail a couple of trades and suddenly you feel like you can't lose, right? Then, confirmation bias kicks in. You start looking for and only seeing the evidence that backs up your theory. And to top it all off, anchoring makes you get fixated on that one perfect entry price you want, completely ignoring what the market is actually doing. It's a recipe for disaster. So now let's see how this all plays out in the wild, in a real market. And we're going to explore exactly why predicting is so risky. Because, as it turns out, the market has ways of, well, punishing this kind of behavior.
Okay, look at this number. 40%. That's a huge deal. According to our sources, a staggering 40% of the time, an incomplete chart pattern, the very thing a predictor is betting the farm on, it just fails. It completely reverses course. Think about that. That is almost a coin flip. And a huge reason these patterns fail is something called a liquidity sweep. Now, this isn't just random market noise. No. This is a tactical move. It's where the big players will intentionally push the price just past a key level, just far enough to trigger all the stop-loss orders from people who jumped in too early. They're basically collecting liquidity before they make the real move.
And when you try to predict a move and you get caught in one of these sweeps, well, you become what's known as a trapped trader. You entered on a weak, unconfirmed signal, and now you're just stuck, watching the market rip in the opposite direction of your trade.
And here's the crucial part. It's the panic and pain of those trapped traders that actually fuels the real move. As they're forced to close their losing positions, to stop out, their panic selling actually becomes the buying power that accelerates the price higher. The market literally uses the predictors as fuel for its real move.
So, okay, if predicting is just a trap waiting to happen, how in the world do professionals stay profitable? It's simple, really. They just flip the script entirely. They don't predict, they react.
This right here, this is the absolute core of the professional mindset. For a pro, a potential pattern is just noise. It's meaningless. That pattern only becomes real, it only even exists when the market proves it with a decisive move, a physical break of a key structural level. And until that happens, they just wait.
And that key signal they're waiting for, it's called a break of structure, or BOSS for short. This isn't a guess. It's not an assumption, it is a clear, objective signal right there on the chart that tells them the market's intention has likely shifted and the trend is probably going to continue.
And this chart shows you exactly what that looks like. You can see we're in a clear downtrend. Every time the price makes a strong, decisive break below a previous low, that's a new BOS. It's not a prediction.
Each one of those breaks is hard data from the market itself, confirming that, yep, the downtrend is still in charge.
So the professional's process is really disciplined, but it's actually pretty simple. Step 1, you watch a potential pattern form, but you keep your hands in your pockets. Step 2, you patiently wait for that clear, definitive break of structure, and only then, step 3, do you actually enter the trade. You let the market make the first move. You just act on its confirmation.
Okay, I know what you might be thinking right now. But wait a minute, if I wait for confirmation, I'm getting in later, at a mathematically worse price. And you're 100% right. So why on earth is this the better strategy?
Well, it's because trading isn't about how often you're right. It's about how much money you make when you're right versus how much you lose when you're wrong. A high win rate, honestly, it's just a vanity metric. Profitability is the only thing that actually matters. All right, let's just look at the math because this is where it all clicks. Look at the predictor. They might win 70% of the time, which feels amazing, right? But with small wins and big losses, their long-term expectancy is negative. They actually lose $50 on average every time they trade. Now look at the confirmer. They win a bit less often, maybe 60% of the time. But because they're trading with confirmed momentum, their average win is 3 times bigger. This creates a solid, positive expectancy of $200 per trade. That is a real, sustainable edge.
And this way of thinking is absolutely crucial if you're a trader in a prop firm or a funding program. In that world, your number one job is not to hit home runs. It's to manage your drawdown and protect the firm's capital. Taking high-probability, confirmed setups is how you survive and grow. You have to wait for the break. So when it all boils down, the crucial takeaway is this. Successful trading is not a guessing game. It's a business of managing probabilities. And you stack those probabilities in your favor with discipline and patience, not by trying to read the future.
So I'll leave you with this to think about. What's the real cost of being impatient? Is it those few extra cents you might give up by waiting for confirmation? Or is it all the capital you lose on a trade that, in reality, was never even there to begin with? Thanks for joining this explainer.